We're still on the hunt, tracking the recession. Our objective is to carefully monitor the economic reports and key market barometers to identify signs of a possible recession. This is our second installment. Also, we're going to talk about our custom sentiment indicator. I'm going to tell you what that says. So, first off, let's recap the news from last week. These are the big numbers. Manufacturing. Inflation's not your friend. We had the Philly Fed released that was in the negative, the first negative number we've seen in quite a while at a negative 7.0. That's not a huge downturn, but it is the first negative number in about the past 7 months. Now, the Philly Fed is broken down into several categories. Notice in particular two things, and this is not the first time we're talking about this. Prices paid, that's one of the strongest segments, that's up 24. Employment, one of the weakest, that's down to negative 5.7. What's the relationship? Why is this important? Prices paid is what the manufacturers pay for the raw materials to make these goods that we buy. The prices paid continues to be one of the strongest segments because of inflation. We just had the PPI. We're going to actually talk about that in just a second. The producer price index that measures the cost of goods on the producer level. Inflation is hurting the manufacturers. They're paying more for raw materials. So what do they have to do? Cut employment, cut the work hours, cut the benefits. And this is exactly what we're seeing. It's a continuous trend that we've seen over time. In blue, that's prices paid. In red, that's the current employment. This goes back about a year or so, and notice the trend as the prices paid continues to move higher as a result of the inflation. The employment continues to suffer. The prices paid up 24, following last month's 19.8. The employment is now negative territory, negative 5.7. We also had last week the Empire State Manufacturing Index. This is the other very big manufacturing report. You'll see a similar relationship. We had a reading of negative 4.7, a little bit better than last month's negative 6.6. But notice this is a ninth consecutive report in negative territory. Now, Empire State Manufacturing is also broken down into several different segments as well. In particular, notice, no surprise here, prices paid up 23.4. The average work week, negative 17.8. That's a huge disparity. And we're seeing this in several different manufacturing capacities. Philly Fed, now Empire State Manufacturing. The higher prices as a result of inflation that the manufacturers are being forced to pay, well, somebody's got to make the cuts. And that, unfortunately, is the employment sector. And we can see here in blue, average work week. In red, prices paid. The relationship is very clear. Prices paid 23.4, a little bit less than last month's 26.5. But unfortunately, the average work week, negative 17.8, following last month's reading, which was just a hair below zero. Retail sales are strong. That was another big number, but not for everyone. Here's retail sales. This is a yearly change. We can see really strong across the board, but to different degrees. Notice in particular that really long green or blue bar up 6.7% on a year-over-year basis. That's non-store retailers. That's online shopping, Amazon, that kind of thing. We have above that building materials up 0.4%. That's not a big year-over-year improvement. And at the top, motor vehicles and parts up 0.8%. Well, what's the relationship? Motor vehicles, their sales have been quite weak lately. Also, building materials, that speaks directly to the housing market. So we can see the housing market and automakers also certainly much more sensitive to higher interest rates. We're less likely to buy a new car, buy a new house with such high interest rates. Well, the retail sales related to these sectors are suffering. Not so much for non-store retailers. Keep this in mind. We're in the middle of earnings season. It'd be interesting to see if Amazon has much better earnings than, for example, Home Depot. On a year-over-year basis, we can see in blue, non-store retailers. In red, building materials. Another very clear relationship. Notice how the blue bars, non-store retailers, they've been strong for the past couple years. Building materials, not so much the case. In fact, this month, up 6.7% on the non-store retailers, following last month's 8.8%. Building materials, positive zero point 0.4 following last month's negative zero point 0.8. On a year-over-year basis, by the way, we can also compare in blue non-star store retailers to the motor vehicles and parts. And in this case, we can see we're barely in positive territory for the motor vehicle sales following last month's negative 3.4%. But the divergence is quite clear. Inflation is cooling, but this is why we still don't feel it. This is why inflation still feels hot. We had this past week CPI and PPI numbers. They tell us inflation's cooling. Well, the CPI, that's in blue. Core CPI is in red. Core CPI excludes food and energy, the more volatile components of the inflation report. And we can see on the CPI, 2.9% on a year over year basis. That's a decline from last month's 3.0. It has been declining very slowly at that, but it is declining. Core CPI up 3.2% on an annual basis, a decline from last month's 3.3%. We also have the PPI, Producer Price Index. Remember, the manufacturers are paying a lot more for those raw goods. Well, PPI up 2.3% year over year, lower than last month's 2.7%. Core PPI up 2.4, a little bit less than last month's 3.1. Now, CPI is broken down into several different categories so we can really measure the rate of inflation among different sectors within our economy. Now, notice in particular, remember the consumer price index, 2.9%? Well, there's inflation in certain areas that are a lot higher, like the rent of primary residence, up 5.1% on a year over year basis. The owner's equivalent rent, it's a different classification, but still monitors the price of rent. And then we have the owner's equivalent rent of a primary residence. Those are both up 5.3%. So when we read the headline up 2.9%, great. That's the entire basket of goods and services. But housing market's, very unaffordable. There's all types of reports saying this is the most unaffordable housing market, we've seen in a long, long time. So most of us have to rent. Well, this is the inflation that we're feeling, 5.3%, 5.1%. This is one of the reasons why it doesn't feel like inflation is cooling. We're still paying 5% year over year increases on rent. Here's in blue, CPI, in red, rent of primary residence. Notice the difference between the two. Again, 2.9% on the headline number that everyone celebrates. Rent of primary residence, that went up 5.1%. And it doesn't look like it's declining very quickly either. Fed futures, they're backing away from the panic. Remember the panic just a couple weeks ago? The Bank of Japan? Well, now we see the Fed funds futures have backed down. The red bars show us the anticipation of a quarter point cut, which would bring us down in the September meeting, by the way, to 5.25 range. Right now it's 5.25, 5.5. The yellow represents a 50 basis point cut to going down to 475, 5.0. Currently, we stand at a 75% probability, this is according to the Fed funds futures, 75% chance we're only going to get a quarter cut. 25% chance we're going to get a half a point cut. But notice just a couple days ago, those bars were in a much different state. Initially, because of the panic that ensued, there was a really strong anticipation and actually a probability that the Fed was going to cut rates by half a point. Now they're going to only cut by a quarter point. That's what the futures are telling us. On the left-hand side, we see here in blue, that's a 75% chance in the September meeting we'll get a quarter point cut, 25% chance, half a point cut. In the November meeting, we're looking at a 63% chance we'll be down half a point by November. There's a 43% chance in December that we'll be down 3/4 of a point. And then there's a 42% chance that we'll be down a full point by January. So it looks like the Fed futures at the moment, at least, are predicting a quarter point cut each meeting, September, November, December, through the end of the year. This has backed down. we were looking at a much more stark cut as a result of the panic which ensued from the Bank of Japan uh, raising rates. But that has backed down. The panic has subsided. Now, our question to you, and we thank everyone for voting on our poll. We've refreshed the poll, so we'd like to ask you to vote again. The question: when do you predict the US will fall into a recession? Well, as of last week's polling, these are the results. First, US elections in November, that had the highest score. That most of us think that we're going to fall into recession by the elections, 35% chance. We asked maybe New Year's at the end of the year, 12%. The first quarter, January, February, March of 2025, 18%. Second quarter or anything after that, 12%. Or maybe we're not going to have a recession. That's a 23%. These are the results of the poll from last week. We've posted up a brand new poll, so we'd like to ask you to vote again, because what we're going to do is compare the difference. We're going to track the sentiment indicator every single week, and we're going to overlay this with our economic numbers to see how the sentiment changes and how that affects our mood. And it's gonna be a very interesting experiment to see how all this plays out. And we're going to continue to update you on a weekly basis with the big economic numbers and the results of our sentiment indicator, and report to you what we found. We thank you for joining us. We look forward to seeing you back soon.